Hello and good morning, folks. A day of surprises was this Thursday. Semi-final loss, and even more surprising was the turn of sentiments in the markets after the US CPI data. We welcome back. We welcome you back to Almus Market Mornings, your daily dose of global financial update with me, Shikhar Garg. And let's dive right into what exactly happened yesterday after the US data release. It was as if the whole market has rejoiced. Equities across the board rallying, currencies finding strength against the dollar. Yields were no outlier to the party. So US CPI numbers, which was expected at 7.9%, printed a data point of 7.7%. And this put the sentiment back towards the discounting of the peak rate, as JK mentioned in the previous session. So JK, you were quite accurate in the identifying that probably the sentiments are moving towards discounting the peak rate. What's going on? I mean, the moves that we are seeing is phenomenal. What's your expectation?
Yeah, good morning. For cricket-loving traders, the downbeat mood after a humiliation against the English side perked up after the data because the risk sentiment has improved vastly. In fact, it has taken a big leap. Obviously, the consumer inflation sprang a big positive surprise with every line of the report showing sequential improvement. Coming at 7.7 year-on-year basis, and that's down from 8.2 in September. The focus should be on the core rate, which is without food and energy, and this was even better, adjusting 0.3% per month on month and 6.3 year-on-year versus 0.5 and 6.5 expected. So barring the shelter, which has the highest weightage of around 27% in the index, most of the other components were showing a decline. So market is also expecting eventually a drop in the shelter rates or the rentals, which means that the future reports could also show a considerable improvement. Data obviously fueled hopes that the peak has passed for the rates, and Fed can now place the rate hikes on a slower path. Some evidence of job market cooling was also there, with the jobless claims for the previous week coming at 225 versus market expectation of 220,000. We're also mindful of the large job cuts in tech companies. We referred to 11,000 jobs being cut in Meta yesterday. Market reactions were very sharp, but were much more than what I would have expected. Yields tumbled and equity surged after the data, and since the treasuries actually saw a drop which was seen in the early days of pandemic, and 30 BP fall in the 10-year, 2-year dropping 33 BPs, and 30-year yield also 25 BPs. The overall fall in the 10-year from the highs is a staggering 50 basis points. The moves are actually exaggerated because of the algos and fast money short covering, which is actually having a big influence in the markets nowadays. Also supporting the yields coming down was the good response to 30-year bond auction, which came 3 BPs better than expected. The corridor of terminal rate has now dropped to around 4.75%. And the hike of December, 75 BP has now dropped to 25% on the expectation side. Just before the data, it was at 50%. Also, the big yields move lower move in the yields had a big impact on other markets as well. Equities surged higher, led by Nasdaq 100 over 7%, Dow by over 3.5%, and S&P by more than 5.5%. These are the biggest single-day gain in over 2.5 years. And it was indeed a big relief rally for the market, which had been frustrated for months with inflation remaining stubborn, even though analysts had been calling for a peak. Even the crumbling crypto markets got supported due to the economic data, with the Bitcoin gaining almost 10%. Currency rally was staggering, of course, a lot of unwinding of a lot safe haven bets in the dollar was seen. Broad surge in risk appetite as well as paring back of Fed rate hike expectations is a double punch for the dollar index, which dropped almost 3% from the highs of yesterday. And dollar yen obviously led the down move in the greenback with fall of almost 4% in the pair. The next, obviously, GBP got a bigger boost because structurally GBP is oversold after several, negative developments in the UK market. Now, GBP has broken even 1.17 in the early trades this morning, and this. Probably these developments of lower yields and improved risk sentiment helps the UK government, which is going to present the medium-term fiscal plan this month. Much of the moves, I can say, in the currencies are down to structural long position in the dollar. Now that is getting paired in a big way. While the basis side, bias of the market has definitely changed to sell on rally for the dollar. Short term looks overdone, and some recovery in the dollar should be seen in the coming session. But I would like to point out that Fed will be very wary of the relaxation in these financial conditions. Indeed, market reaction has been swift and aggressive with the sharp falls in Treasury. And some interpret that one CPI down surprise means that Fed's work is almost done. But Fed doesn't want to signal that as yet and will continue to, oppose a loosening of the financial conditions. And that because that will undermine all the hard work done by them in containing the inflation. In fact, speaking immediately after the data release, some officials, while welcoming the fall in inflation news, warned that further tightening is still warranted. We would expect some fairly hawkish rhetoric over the coming days, by the Fed members. And while there will be a moderation in the size of the rate hikes, inflation is not defeated, so the Fed has more work to do with a higher terminal rate than it signaled in September. Of course, on the political side, we still have no final picture on the composition of the House and the Senate, but definitely Republicans have made good progress in the election so far. On the rupee, yes, a huge one-way bet for several months. I know only RBI selling had helped the rupee to make some intermittent recoveries, but more or less after the break of 77 and more after the 80 break, market had become one-sided and selling was almost non-existent. And the last few days that has changed. In my view, first signs were the break of 82 on the technical chart and the move yesterday after the dollar index falling nearly 3% from the peak actually triggered a much larger selling in the USD INR. I think a lot of people have been bailing out of their long positions. Now, what is in store for us after falling nearly 1.5% from the peak of yesterday is it looks overdone. Definitely, India's fundamentals, I have not seen any change. We still have high deficits. We do not know how much flows will be there going forward. Although this macro stability in the global markets and the rates possibly peaking can also put Indian bonds on an attractive path. So for sure, sell and rally in the USD INR will be there, but the near-term big fall may be resisted by RBI. They might actually come and mop up the flows ahead of 80 levels. So we should be slipping into a range between low 80s and 81.5. 81.5 looks a bit ambitious right now. I think anything above 81.10 would be latched onto by the exporters as well as the investors. I think these moves are somewhat disruptive for the export sector, which the government is looking to, get good performance to address our overall GDP as well as to improve the trade deficits. Therefore, I think further big fall in the USD INR should not be expected immediately, although the upside remains very well capped at 81.1020. Thank you.
Okay, interesting, JK. And yes, I mean, what amazing moves are we seeing in the financial markets? Just right after the data, we saw the crumbling crypto markets were supported. There was a biggest single day gain in almost 2.5 years for all of the across equity market segments. A significant drop in yields were seen, while the expectations of the terminal rates, as JK mentioned, have come down to 4.7%. Now, these developments have shown what sort of a risk sentiment shift are we observing right after the data point released. But folks, this is not the end, as JK mentioned. Fed is still on its path and on its trajectory towards fighting inflation, and it may not be over yet. While on the domestic front, yes, we are seeing a lot of appreciation for INR, but folks, the macro conditions haven't changed. That JK mentioned, we still have a high deficit, and flows, though, can be expected because of the higher yields, but is still a question. So let's continue to manage our risk and end the day by saying TGIF. Probably we can also see a new high for our equity indices as well. The way it looks in the off market or the SGX market updates. So that's it for today, folks. We shall come back again on Monday with another round of fresh updates, as the financial markets have been going out very and crazy and uh, all over the place. So a lot of updates coming your way on everyday basis. Keep signing in and enjoying the updates. That's it for today. Thank you so much for listening.